Stop! Before you scroll past, take a moment to think about your money. Are you letting your hard-earned cash just sit in a bank account barely growing? If so, you could be missing out on something big, something that could make a real difference to your savings, your future plans, and even your peace of mind. Before you let your cash sit in a low-interest savings account, listen up. Most people don't realize just how much money they're leaving on the table by sticking with the status quo. Banks might feel safe, but with interest rates still lagging behind inflation, your savings could be quietly shrinking in real terms. Right now, millions of people across the UK are missing out on over 5% returns that are available without taking on the rollercoaster risks of the stock market. Imagine what an extra 5% could do for your emergency fund, your house deposit, or even your holiday savings. That's money you could be earning simply by making a smarter choice. The secret? Money market funds. These aren't some mysterious, high-risk investments. In fact, they're designed to be simple, stable, and accessible. You don't need to be a financial expert to use them, and you can usually access your cash quickly, sometimes even the same day. It's like having the flexibility of a savings account, but with the potential for much better returns. Here's the harsh truth. If your savings aren't beating inflation, you're actually losing money every single day. Inflation quietly erodes the value of your pounds, making everything from groceries to holidays more expensive. That's why it's so important to make sure your money is working as hard as you are. Let's cut through the jargon. In this video, I'll break down exactly what money market funds are, how they work in the UK, and why they could be the perfect home for your emergency fund, your house deposit, or any cash you want to keep safe but still see grow. We'll look at real-life examples so you can see how these funds fit into your financial plan. Unlike stocks, which can swing wildly up and down, money market funds are built for stability. They invest in short-term, high-quality assets, aiming to keep your money safe while still delivering a return that outpaces most savings accounts. If you're risk-averse or just want a safe place for your cash, these funds could be exactly what you're looking for. And here's the best part. With interest rates currently high, money market funds are able to react quickly. When the Bank of England raises rates, these funds can pass those better rates on to you, often much faster than traditional banks do. That means your money starts earning more, sooner. Think of money market funds as a supercharged savings account. They're still cautious, still focused on safety, but they give your cash the boost it needs to keep up with the times. You don't have to lock your money away for years, and you don't have to worry about wild market swings. It's time to make your money work harder for you. Whether you're saving for a rainy day, a big purchase, or just want to stop losing out to inflation, there's never been a better moment to explore your options and take control of your financial future. In the next few minutes, you'll learn the pros and cons of money market funds, what fees to watch out for, and exactly how to get started, even if you've never invested before. I'll give you practical tips and clear steps, so you can make the best choice for your situation. My goal is simple: to give you the facts, cut through the confusion, and help you make a smart, informed decision about your money. Ready to take the next step? Let's get started.
Let's break it down. If you've ever wondered where people park their cash for safety and a bit of extra income, you're about to find out. Money market funds, or MMFs, are a popular choice for both everyday savers and big institutions alike. At their core, a money market fund is a large pool of cash collected from thousands, sometimes millions, of investors. Think of it as a giant communal pot, where everyone chips in their money to be managed together. But instead of using that money to buy shares in companies, the fund acts more like a lender. It loans out the pooled cash for short periods to some of the most trustworthy borrowers around: governments, major banks, and top-rated companies. These are the kinds of borrowers who are least likely to default. The fund invests in ultra-safe financial instruments like UK Treasury bills, certificates of deposit, and commercial paper. These are essentially IOUs, promises to pay back the money with a bit of interest in a short time frame. They're considered some of the safest places to park cash. The loans made by the fund are typically very short-term, sometimes just a few days, often a few weeks, and rarely longer than a year. This constant cycle of lending and repayment helps keep the fund's value stable and generates a steady stream of returns for investors. One of the main attractions of a money market fund is safety. Your money is spread across many borrowers and investments, reducing risk. Plus, you can usually access your cash quickly, sometimes even the same day you request it. In today's environment, where interest rates are higher than they've been in years, the returns from money market funds have become especially appealing. They often outpace regular savings accounts, making them a smart option for short-term savings. By pooling your money with others, you gain access to investment opportunities and interest rates that are usually reserved for large institutions or wealthy investors. It's a way for everyday people to benefit from the power of scale. Best of all, the fund's managers handle all the research, paperwork, and day-to-day decisions. You simply invest and the fund does the heavy lifting, earning you interest minus a small management fee. It's a simple, low-risk way to make your money work a little harder. Why pick a money market fund over a savings account? First, safety. These funds invest in high-quality short-term debt, making them very low risk. Second, liquidity. You can usually get your money back in a couple of business days, no lock-ins or penalties. Third, returns. MMFs track official interest rates and update quickly, unlike slow-moving banks. They're ideal for large cash balances too. No need to spread money across banks for protection. While not covered by the FSCS, their diversification and quality offer strong security. For short-term savings or emergency funds, MMFs are a smart, efficient choice. You get a fair, competitive rate, without the hassle. Let's talk risk. Money market funds are low risk, not no risk. Your capital is at risk, but losses are extremely rare. Major funds breaking the buck is headline news. The main risk is if a top-rated borrower defaults, but strict rules and diversification make this unlikely. Interest rate risk means your returns drop if rates fall, but your capital stays safe. MMFs aren't covered by the FSCS, but their assets are ring-fenced and diversified. If your platform fails, your investment is still protected. The real risk is tiny and lies in the fund's assets, not the platform. For most, the safety is more than enough for short-term cash. Here's how returns work. UK money market funds track SONIA, the overnight rate banks pay to borrow cash. SONIA moves in step with the Bank of England's base rate, so your returns rise or fall with official rates. The fund earns daily interest and your holding grows a little every day. Steady, predictable, and transparent. Unlike banks, which keep a chunk of the rate, MMFs pass almost all of it to you, minus a tiny fee. No sudden jumps or drops, just a smooth, daily increase. You're cutting out the middleman and getting a rate close to the true cost of money. That's the MMF advantage. When choosing a money market fund, you'll see income, INC, and accumulation, AC versions. INC pays out interest as cash, great if you want regular income. AC automatically reinvests interest, growing your pot without extra admin. For most savers, ACC is simpler and benefits from compounding. If you need cash flow, pick INC. For growth, pick AC. Remember, both are taxed as income unless held in an ISA or SIPP. With AC, you're taxed on reinvested interest, with INC, on what you receive. Most platforms provide tax certificates to help you out. Choose the version that fits your needs and tax situation. Where does a money market fund fit in your plan? It's for stable, accessible cash, not long-term growth. Compared to savings accounts, MMFs usually offer better rates and faster updates, but lack FSCS protection. Stocks and shares are for long-term growth and carry much higher risk. Never use them for emergency funds. Bonds are a middle ground but can lose value if rates rise. MMFs avoid this by lending short-term. Premium bonds are safe, but returns are luck-based, not guaranteed. MMFs give everyone a steady, predictable return. In short, use MMFs for cash you need safe and accessible, but still want to earn a decent rate. They're the sensible home for your short-term savings, not a magic bullet, but a powerful tool. When it comes to choosing the right money market fund or MMF for your needs, the options can seem overwhelming at first. With so many funds available in the UK, each with their own features and benefits, it's important to know what to look for. So, which MMF should you pick? Let's break it down step by step to help you make the most informed decision possible. The first thing you should focus on is the fees each fund charges, as well as whether the fund is available on your chosen investment platform. Not all funds are accessible everywhere, and fees can eat into your returns over time, so these are crucial factors to consider. Take the Royal London Short-Term Money Market Fund for example. It's a popular choice among UK investors because it's not only low cost but also widely available across many platforms. Its reputation for reliability and transparency makes it a go-to option for those seeking stability and ease of access. Similarly, Legal & General's Cash Trust stands out for its competitive fees and the strength of its well-known brand. It's easy to find on most major investment platforms, making it a convenient option for many investors who want a straightforward, hassle-free experience. If you're comfortable trading ETFs, money market ETFs like the Lixor Smart Overnight Return, CSH2, or iShares SONIA, SONI are worth considering. These ETFs typically offer some of the lowest fees in the market, which can help boost your returns. However, you'll need to use a platform that supports ETF trading, and it's important to keep an eye on any additional trading costs or commissions that might apply. For those who already use Vanguard's platform, the Vanguard Sterling Short-Term Money Market Fund is an excellent choice. It's designed for simplicity and cost-effectiveness. and you can invest directly through Vanguard's user-friendly website, making the process smooth and efficient. Ultimately, the main difference between these funds comes down to cost. Lower fees mean you get to keep more of the interest your money earns, which can make a significant difference over time, especially if you're investing a large sum or planning to hold your investment for several years. Always take the time to check which funds are available on your chosen platform and compare the charges side by side. Some platforms may offer exclusive funds or special deals, so it pays to shop around and do your homework before making a final decision. Remember, all these money market funds are designed to do essentially the same job: keep your cash safe while earning a bit of interest. Since their performance is similar, the deciding factor should almost always be cost. The less you pay in fees, the more you keep in your pocket. So when you're ready to invest, pick the cheapest and most convenient option available to you. This approach ensures you're not leaving money on the table and that your investment works as hard for you as possible. By focusing on low fees and easy access, you'll maximize your returns and make your money work smarter, not harder. That's the key to getting the most out of your money market fund investment. Ready to get started? Here's your action plan. Pick a platform: Hargreaves Lansdowne, AJ Bell, Fidelity, or Vanguard, and open an ISA or general investment account. Compare platform fees. Flat fees are better for large sums. Search for your chosen MMF, decide between ACC and Inc., and invest. Transactions may take a day or two to settle, normal for these funds. Remember, interest is taxable outside an ISA or SIPP, and payouts aren't instant. Allow 2 to 3 working days to withdraw. MMFs are a great tool for fair returns on cash, but always check they fit your needs. That's it, your money working harder.